that work for you? So there is a volume imbalance in here because the bodies are not overlapping that gap between the two bodies here. So the close of this candle, the close of this candle and the open of that candle, it's lacking a candlestick body. You see that? So what does that mean? It means that that range that I'm highlighting here can be revisited. Now, Chris Laurie and anyone else that talks about those inefficiencies, those imbalances, those liquidity voids, that's not a liquidity void, this is an inefficiency. Okay, a liquidity void is an actual gap between one period to another, where there is no wick, there is no body. That is a liquidity void. It's void of all liquidity. This is not a liquidity void. There was buying and selling in between the close and the low. There was buying and selling between the open and the high. Both of those two price points or two time intervals, the individual daily candlesticks, they both intersected and overlapped a little bit there. So that is not a void. It's not a void. It's inefficient. So what is it needing here? What does it need? And if we open down here on a Monday of non-farm payroll week, so if it's an inefficiency like this where there's no bodies, we can anticipate the market wanting to reprice up into that. Even if it goes higher, it doesn't matter. That gives you an opportunity to do what? Sell short here and reach for the liquidity that was used prior to the run up. But if it's bearish, this is a wonderful area to see price draw up into, thinking what? We created a low, we created a bottom, because the stock market by itself is predisposed to go where? Up. It's ingrained in everybody's mind to buy stock. Buy stock. Buy the stock market. Be a holder. So that premise is constantly primed in the thought processes of traders. I want to buy stock. I want to buy call options. I want to buy something. So if we open up here, it gives you the inclination that, well, hey, look, we gapped up higher from where we closed on Friday. So that it gapped up. We traded down a little bit. Okay, wonderful. And then sent it up to a level that is predetermined, that these exist. I taught it to you. It's there. That blue shaded area was in my chart from the time my trade opened until I managed the close of it. That's not random. But the logic was it's going to offer a revisiting of this area because there's no body. Now, there still isn't a body. It's just a wick. Today's wick went there today. And volume imbalances, we know that it's likely to go through them. That's one of the PD arrays that you have to have a lot of flexibility. And they can also be used multiple times until, this is for your notes for the folks that aren't writing anything down, once there's a body laid over top of the close, the open here, whether it be an up close or a down close, once the body is laid across that, I'm not going to refer back to that volume imbalance ever again. That's not to say that you can't use it again. I'm saying that I won't use it. That means it's expired at that point. But it will not expire at all until there's a body laid across this range. And this is just a wick, okay? So there's logic there. There's sound logic being employed there. It's not just some conjecture. It's something that I've taught my students. It's something I use in trade examples that I'm showing you. I use it in my analysis when I'm talking to you on these higher time frame charts. You've seen me doing it now for a year and a half publicly now. What have you seen me get wrong? Short list. It's a very short list, isn't it? So I'm counseling you to don't just take my word for it. Go back and look at the things I've taught you and see if you see them in the chart. And you're going to be convinced rather quickly that it's there. So then you have to sit in front of the charts and learn how to see them happening real time. And in the beginning, you're not going to know what it looks like before it happens. But then over time, you'll start recognizing things. Oh, I've seen this before. This is like that thing he talked about. And then boom, there it is. Every one of my students have the same epiphany. Not at the same time, not the same length of time, but they all had the same thing. Wow, it happened when I wasn't really expecting it. It just happened, and I can see it now. But once you understand it and you see it, you can't unsee it, but you can't rush it either. And that's the part I wish I was better at as a teacher to help you with that. But in my honesty, I don't think there's a way to do it because all of us bring our own baggage to it. The things that we wrestle with the most. So that's the imbalance, the volume imbalance on the daily chart. And we've dropped down to a 4-hour chart now. You see how even on the 4-hour chart we have that. But look, was that a candlestick body? Nope. But on the 4-hour, what do we have here? Did it close over top of that with a body? Nope. It still had this portion here. So this is still in play. It can be utilized again. It's not expired. 60-minute chart. Same thing. Did the body close it in on any one of these candlesticks? Nope. So that does what for me? It tells me that this needs to stay on my chart. If we go into a time frame, hourly, 4-hour, or daily, and a body is laid over top of it, why am I using these time frames? Shit, he just read my mind. Why not any other time frame lower than that? Because 1 hour, 4-hour, and daily are my swing trading time frames, and I don't want to use a daily volume imbalance and cancel it with something less than an hourly chart. Look at my core content lessons where I talk about how using one time frame with another time frame to qualify another trade. I talk about that in greater detail. I'm not going to waste my time with it here because I've already done it. A long-winded discussion there with real examples and how to think about moving one time frame to the next if I'm swing trading, short-term trading, or day trading. All right, so let's look at the 15-minute time frame just for the sake of market structure. And even on the 15-minute time frame, it didn't quite close it in with the body. So you can see how it's done. Everything I'm teaching you how to use a volume imbalance, all those signatures are still here. Okay. So in short, what that means is it can still run back up here and touch the low end or consequent encroachment of it and not get up here and still go lower. Or it can go all the way up and close it in and go lower. That's one of the things that we could probably see because it's not from a week. So to me, like I'm done. Like I'm content. $17,000, one clip on a Monday of non-farm payroll, delivered beautifully with precision. I'm satisfied. Like I'm done. I'm good. I don't need to do anything else in the PM session today. I don't need to do anything on Tuesday. I don't need to trade on Wednesday to squeeze something else out. And I certainly don't need to do anything on Thursday and Friday of non-farm payroll. But contrast that with every other retail trader out there. They're anticipating a lot of movement on Friday. So they have their hopes set up for a lot of action on Friday. And that's something that I tried to steer all of my students away from because you shouldn't be excited about taking the trade. It should be boring. You should be bored out of your mind that I'm going to do something I've been doing, and it's probably going to do the same thing I expect to see happen any other time.